Hi everyone, this is Pinkasha from Pazcare. We have with us today Megha, and thank you so much, Megha, for joining.
Yes.
Yes, everybody, this is Megha Jain from Cleartax, and we have with us her today. She's an experienced income tax specialist with almost a decade of experience in direct taxes. So over to you, Megha. I just wanted to give people the context of why we are here today. So, as you
Sure.
know, there's the National Youth Day that we celebrate on January 12th this year. And the theme of this year's Youth Day is being progressive. And India has the largest population of youth. We account for 65% of India's population. So the best way to be progressive is money management and going forward with how we can better prepare for the future. So that's why we've hosted this webinar today, and we have with us Megha again from Cleartax, who will be the host of the day, answering all your questions and helping you become more financially aware and helping you save more taxes and make better investments in future. Hi Megha, thank you so much. Over to you.
Yes. Thank you. Thank you so much, Pinkasha. And also to all the audience members here, I can see that we have a very good participation rate today. A very happy National Youth Day to everybody. And as Pinkasha rightly pointed out, we are a growing economy, not just in terms of our revenue numbers, our economic numbers, but also in terms of the population we have. We have a highly energetic youth population, and this is evident in the country's growth rate and also the tax collections. So if you see the data presented by the government recently of the year gone by, there has been a significant increase in the personal tax collection, which is a clear sign of not just the economy growing, but also more people entering into the taxpayer stream. So the more taxpayers we have, the higher the tax collections are. So year on year growth is to the extent of nearly 24%. So with this, it becomes very important and to take charge of your personal finances, your personal taxes, because taxes again make up a big chunk of the money that we get. So if you know how to handle your taxes well, how can you maximize them in terms of tax savings, that will pave way for you for a more financially sturdy future. So today's segment is all about tax savings, investments, and also certain upcoming deadlines or certain upcoming regulatory or statutory requirements which you may have to fulfill. So the first segment of today's session concerns with investments. What are the various investments you can go ahead and make from a tax perspective? What are the certain expenditure that you can have that will help you save more taxes? Then we have the second segment focusing on investment declaration. So whatever are the investments that you've made, how do you take the maximum benefit out of them? What are the ways in which you go ahead and submit those expenses so that you get the tax breaks? Then the last segment, we discuss the budget highlights. The budget which was presented in July 24, and also a very interesting and a new topic, updated return of income. Now, this may become relevant to a lot of you or some of you, depending on your circumstances. So please stay tuned to the entire duration of the session. And also at the end of the session, we will have a dedicated space for Q&A. So we will have a 10-minute dedicated space. So if you have any questions during that, please put that in the chat box. So without much ado, let's begin. First up, let us go ahead and discuss the tax exemptions on HRA and LTA. So HRA is a significant component of all our salaries. Our salaries typically made up of basic HRA and LTA. Depending upon the rent that you're paying, you can go ahead and claim HRA exemption. So the formula for HRA exemption is as follows. It is either, there are three elements, the least of the three will be exempt. The first element is 40 to 50% of your basic salary. Now this is related on the place of residence. So if you're residing in any of the four metropolitan cities, that is Delhi, Mumbai, Kolkata or Chennai, then you can go ahead and claim up to 50% of your basic salary. If you're residing anywhere else, it is 40% of your basic salary. The second criteria is the actual amount of HRA received. And the last criteria is actual rent paid minus 10% of your basic salary. So the least of these three criteria becomes HRA exempt. Let us understand this by way of an example. Let us say that you are a resident of Delhi. Hence, you can go ahead and claim up to 50% of your basic salary. For the purposes of example, let's say it comes up to rupees 3 lakhs. 50% of your basic salary is rupees 3 lakhs. The actual amount of HRA that you get is rupees 4 lakhs, and the actual rent paid minus 10% of your basic salary is rupees 2.5 lakhs. So the three criteria we have are rupees 3 lakh, rupees 4 lakh, and 2.5 lakh. So 2.5 lakh being the least of the three values will be the amount of HRA exempt. So out of the total HRA of rupees 4 lakhs that you get, 2.5 lakh shall be exempt and the remaining 1.5 lakh shall be offered to tax as income from salaries. Next up we have LTA, that is leave travel allowance. Leave travel allowance is allowed only under the old tax regime, so is HRA. Now, leave travel allowance is allowed twice in a block of 4 calendar years. The current block is from the year 2022 to 2025. So in this block of 4 years, you can go ahead and claim two LTAs. The most important thing with respect to LTAs is that they can be raised, they can be claimed only for domestic travel. If you're undertaking any international travel, you will not be eligible to claim LTA. LTA is restricted to domestic travel. This travel can either be by railways or airways, and where the two places are not connected either by an airline or by railways, any other public mode of transportation is allowed. LTA can be claimed not just for yourself, but also for your spouse, your dependent parents, and siblings. Please remember the maximum amount of LTA is dependent upon your organization's policy and subject to the actual amount of expenditure you make. So you can go ahead and claim the round trip expenditure. Only travel expenditure is allowed. If you incur any additional expenditure on boarding, lodging, any other personal expenditure, such expenditure shall not be allowed. If you have any unutilized LTA from the current block, you can carry forward one LTA to the first financial year of the upcoming block. So let's say, for example, in the current block, which is 2022 to 2025, you have utilized only one LTA. So in the upcoming block, in the first year, that is in the year 2026, you can go ahead and claim another LTA in addition to the two LTA of the subsequent block. I hope that's clear. I repeat, HRA and LTA are allowed only under the old tax regime. Now let us identify an investment opportunity and the tax benefits around that investment opportunity. So as we all know, real estate is getting big in India. A lot of people are now moving towards investing in their own property. They do not want to stay in rentals anymore, of course, given the skyrocketing rentals in India. So here is where the income tax benefit goes ahead and gives taxpayers an opportunity to save taxes on their housing loan repayments. Housing loan repayments, both in the form of principal and interest repayments, attract tax benefits. Currently, we are discussing only tax benefits on the interest component. First up, we have deduction towards interest payable under section 24B. So, under this section, you can go ahead and claim up to rupees 2 lakhs per annum for a maximum of two self-occupied property. This is allowed only under the old tax regime. The most important bit to note here is that the deduction will be allowed only from the year of possession. So the year in which you start getting the possession of the house, that is a year in which you start getting tax breaks. So now you may wonder, what about the interest I may have paid earlier on? Such interest which you pay before getting the possession of the property is typically known as pre-construction interest, and pre-construction interest can be claimed in 5 equal installments from the year in which you get the possession. So the maximum amount that can be claimed is rupees 2 lakhs. This 2 lakhs can be of pre-construction interest and the current year interest, entirely of the pre-construction interest or the current year interest. And in case it is a co-owned property, then both the owners can go ahead and claim deduction for housing loan interest paid in the proportion of their ownership. An additional deduction is given to the extent of rupees 1.5 lakhs under section 80 EEA. Now, this is a section wherein an additional deduction is given over and above the rupees 2 lakh limit on satisfaction of certain conditions. The conditions are as follows. The loan must be taken under the affordable housing scheme of the government of India, and this must be for a first time home buyer. So if you're a first time home buyer and if you have taken a loan under the affordable housing scheme, then you're eligible under this section. And the second and the most important condition is that the loan must be taken between 1st April 2019 to 31st March 2022 from a financial institution in India. So this particular provision comes with a sunset clause. If you have taken a loan before April 2019 or after March 2022, you will not be eligible. Furthermore, the stamp duty value of the house property should be 45 lakh rupees or less. If you fulfill these conditions, you can go ahead and claim additional deduction of up to rupees 1.5 lakhs. Next up, we have investments under Section 80C. So Section 80C is one of the most popular sections. This is something most of us know. However, 80C consists of a lot of investment opportunities. And the most important thing with respect to Section 80C is that the overall limit or the maximum limit of deduction under Section 80C is capped at rupees 1.5 lakh, and this is available only under the old tax regime. First and foremost, under Section 80C, we have deduction for any contribution made towards Provident Fund. Now, Provident Fund is a sort of investment we make for our future security. It is a social security benefit scheme. So, for our retirement, the investments that we make, Provident Fund can take three different items. It could be employee provident fund, voluntary provident fund, or public provident fund. Employee provident fund, as we all know, is something, a contribution which you make in your employment. So your employer contributes a certain percentage of your basic salary, and you also go ahead and contribute a certain percentage. Whatever is the contribution you make, that is eligible for deduction under Section 80C. In addition to that, we have contribution to VPF. Now, VPF is known as Voluntary Provident Fund. It is an extension of EPF. So if you want to go ahead and contribute more than the statutorily applicable limits for EPF, you can opt for VPF. Whatever is the contribution you make, up to 1.5 lakh is eligible for deduction under Section 80C. Lastly, we have the Public Provident Fund. Now, this is a contribution you make to Provident Fund outside of your employment. So you can go ahead and contribute to Public Provident Fund, not just in your name, but also in the name of your spouse or your child. The ceiling limit to make contribution to Public Provident Fund account is rupees 1.5 lakhs per annum. Any interest that you get from this Public Provident Fund is tax exempt. Next up, under Section 80C, we have payment of life insurance premium. So if you have taken a life insurance policy from any insurer approved by the IRDAI in your name, your spouse's name, or the name of your child, whatever is the premium that you pay, that is allowed as a deduction in the year of payment. In case your policy comes with a clause of lump sum premium payment, for example, if the tenure of the policy is 10 years or 3 years and you have paid a lump sum premium, then the deduction will be restricted in a proportionate manner. Next up, we have investment in ELSS. Now, this is a very important investment option, and please understand you have to invest only in ELSS. Now, ELSS is a type of mutual fund specifically designed for tax savings for individuals. Not all mutual funds are ELSS. However, all ELSS are mutual funds. So if you are investing in mutual funds, you will not be eligible for 80C benefits. However, if you are investing in ELSS, which come with a 3-year lock-in period, then you will be eligible for deduction under Section 80C. These come with a minimum 3-year lock-in period, and if there is any capital gains at the time of maturity or exemption, such capital gains will have to be offered to tax. Next up, we have repayment of housing loan principal. So earlier on in the session, we discussed housing loan interest. Now we talk about housing loan principal. Housing loan principal repayment is covered under Section 80C. So any principal repayment that you do or any other stamp duty or registration fee you may have paid at the time of purchase of your property, that can be claimed as a deduction under Section 80C. Once again, under Section 80C, for principal repayment, you will be able to claim the deduction from the year of possession. Next up, we have investment in fixed deposit. So if you want to have a stable investment, which is risk-free, then you can consider investing in FDs. If you're investing in FDs, which come with a minimum lock-in period of 5 years, you will be eligible for 80C deduction. However, the year-on-year interest that you get from investment in FDs, such interest shall be taxable as income from other sources, and the rate of tax will be the applicable slab rate. Under section 80C, the next series we have is expenses. So if you have a child who is studying in a school, college, or university and you're paying tuition fee for the same, such expenses deductible under section 80C. It is allowed for a maximum of 2 children up to the higher limit of the cap of section 80C. Please remember, only tuition fee is allowed. Any other deduction or any other fee that you pay, whether it is library fee, transport fee, or management fee, such fee is not allowed. Only the tuition fee component is allowed. Next up, we have investment in Sukanya Samriddhi scheme. Now, Sukanya Samriddhi scheme is a very lucrative way of investment. Here, you go ahead and get benefits. So it is one arrow, two bird situation. You take tax benefits, at the same time, you also save up for the future of your daughter. The minimum contribution per annum is rupees 250 and the maximum is rupees 1.5 lakh per annum. The condition is that your daughter must be below the age of 10 years at the time of opening the account. Contribution can go on up until the age of attainment of 21 years. Partial withdrawal at the age of 18 years is permitted for the purposes of education or marriage of your daughter. And any money you get in the form of interest from investment in Sukanya Samriddhi scheme account will be tax exempt. The other investment alternatives under Section 80 CR, investment in National Savings Certificate, investment in Senior Citizen Savings Scheme. So this is for people who are above the age of 60 years, investment in ULIPs, investment in any other post office deposit scheme, NABARD bonds, etc. Now, these post office deposit scheme, NABARD bond investments are entirely risk-free investment. So if you do not have the appetite for risk, then you can go ahead consider investing in these items. Next up, we have investment in pension products. Now, here is where I would request the audience members to pay attention because this can get slightly tricky. So, investment products, for ease of understanding, we have divided them into three categories. First up, we have investment in a pension plan, which is an annuity plan of LIC or any other insurer for the purposes of pension from an approved fund. So, basically, if you are investing in a pension plan covered under Section 80 CCC, then you can go ahead and claim up to rupees 1.5 lakhs in deductions. Next up, we have contribution to pension covered under Section 80 CCD 1 and 2, which refers to pension scheme of the central government. So Section 80 CCD 1 concerns with employees' contribution, that is your individual contribution, and Section 80 CCD 2 considers employer's contribution made on your behalf. So if you are contributing anything in your personal capacity, maximum of up to 10% of your basic salary, subject to rupees 1.5 lakhs, is eligible for deduction under Section 80 CCD 1. If your employer is making a contribution on your behalf, then up to 10% of your basic salary under the old tax regime and up to 14% of your basic salary under the new tax regime is allowed as a deduction. Here comes the most important part. Now we discuss Section 80C, Section 80 CCC, and CCD 1. Each section has an upper limit of 1.5 lakhs. However, as per the provisions of the Income Tax Act, the total deduction as a combination of these three sections cannot exceed rupees 1.5 lakh. So, irrespective of your contribution, the deduction will be capped at 1.5 lakh. Let us understand this with the help of a numeric example. Let us say you are investing in FDs, rupees 1.5 lakh. You're also investing in annuity plan of LIC, rupees 1.5 lakh. And you're investing in NPS of the central government under CCD 1, rupees 1.5 lakh. Your total contribution now is rupees 4.5 lakh. However, for the purposes of Income Tax Act, your deduction will be capped at 1.5 lakh. I hope that's clear. And your employer's contribution is additional. That will get you an additional deduction depending upon whether you're opting for the old tax regime or the new tax regime. However, as regards your personal contribution, it will be capped at 1.5 lakhs. Next up, we have deduction under Section 80 CCD 1B, which is additional contribution to pension scheme of the central government. This is allowed only under the old tax regime. Here, if you're making an additional contribution to pension over and above 80 CCD 1, you can go ahead and claim an additional deduction of 50,000. Let us continue the previous example to understand this. In the previous example, you had invested 4.5 lakhs. Now let us add an additional 50,000 to that as contribution to additional pension. So now the total contribution comes up to rupees 5 lakhs. From this 5 lakhs, now you will be eligible to go ahead and claim deduction of up to rupees 2 lakhs. I hope this is clear. Now let us go ahead and understand what an investment declaration means. So earlier on, we discussed the various investment avenues you have, whether it is Section 80C, whether it is investing in a house property, whether it is investing in pension products, etc. Now, what is an investment declaration? An investment declaration refers to a declaration of your investment that you make to your employer. Now, if you remember, in the month of April 2024, you all must have done an exercise wherein you can go ahead and declare your investment on an estimate basis to your employer. So you fill out a form or your HR portal stating that these are the expenses you have, this is the amount of rent you pay, this is the probable amount of ATC deductions that you may be claiming. So on the basis of that, your employer goes ahead and computes your tax liability for the year and apportions that into a monthly TDS. Correct. So you go ahead and make investment declaration on an estimate basis in Q1. However, in Q4, which is right about now in the month of Jan or Feb, you go ahead and submit proof. So whatever were the investment declarations you made, you have to submit the proof of such investment or the proof of such expense in Q4 of the financial year. So that is known as proof submission. Now, timely proof submission helps you to go ahead and get a higher in-hand salary and a lesser TDS. Now, investment declaration is not limited to investments alone, also expenses. For example, if it is tuition fee, whether it is LTA or HRA. So all the investment declarations are made in Form 12BP. In addition to that, there was a recent amendment wherein the government now lets individual to claim credit of TCS, that is tax collected at source. So if you have any tax collected at source, you can go ahead and make a declaration of the same to your employer, and such TCS will also be factored in to compute your total tax liability for the year. Now, TCS is a form of tax collection which happens on any expense you make. For example, if you have purchased a vehicle, then there will be a TCS. Or on the other hand, if you have spent more than 7 lakh rupees on foreign travel, or if you have encashed more than 7 lakh rupees in a foreign currency, then there will be TCS applicable. So all this TCS can be claimed, usually earlier it could have been claimed at the time of filing the return of income, but to ensure that there is higher liquidity in the hands of the taxpayer, and also a taxpayer does not pay additional taxes and claim a refund later, the government has now enabled taxpayers, salary taxpayers especially, to be able to claim this TCS through their employers. So you can go ahead and make that declaration. Please connect with your finance, HR, payroll to understand how to go about this and make such declaration. The reason why we're stressing on making the right proof submission is to ensure that you do not have any excess tax leakage at the end of the year or at the time of filing the return of income. And if there are any excess taxes that you may have paid, the same can be claimed in the form of refund at a later point in time. Similarly, if you have missed out submitting any proof, for example, if you are not able to get the right document in a timely fashion, then whatever is the investment that you have made, you can go ahead and claim the deduction for the same at the time of filing the return of income. Now, what are the expenses eligible for deduction? We discussed a few expenses such as housing loan, HRA, LTA, etc. Let us also discuss a few more. If you have any medical insurance premium or medical expenditure, the same can be claimed under Section 80D. Let me elaborate a little on medical expenditure. Now, Section 80D makes a provision for medical expenditure as well. So, if you have a parent who is above the age of 60 years and such parent is not covered under any existing medical insurance in India, either outside or at your employment, then you can go ahead and claim up to rupees 50,000 towards medical expenditure. This medical expenditure entails diagnostic bills, monthly medicine bills, doctor visit, OPD expenses, etc. However, twin conditions have to be satisfied. The first condition is that the person for whom you want to claim the medical expenditure, which can either be you or your parent, must be above the age of 60 years and they must not be covered under any existing medical insurance. If these two conditions are satisfied, you can go ahead and claim additional 50,000 rupees. Then we have interest on education loan. So if any of y'all have any running education loan, whatever is the interest that you pay out, such interest on an actual basis can be claimed as a deduction. Then if you have received any savings bank account interest, interest up to 10,000 is deductible. Any savings bank account interest up to 10,000 is deductible in the case of a person below the age of 60 years. If the person is above the age of 60 years, up to rupees 50,000 can be claimed as a deduction. The various other deductions that are available are any donations you make to any approved charitable institution, you can claim that as a deduction. If you or any of your dependent family members are suffering from any disability, such as locomotor disability or autism, low vision, blindness, hearing impairment, etc., then also you can go ahead and claim deduction. Or if they are suffering from any specified diseases, such as cancer, AIDS, thalassemia, etc. In such cases also, for the purposes of their treatment, you can go ahead and claim an additional deduction. Now let us understand what are the investment proofs for all the deductions that we discussed. If you want to claim HRA, the corresponding proof that you will have to submit is rent agreement or rent receipts. And where the annual rent paid exceeds rupees 1 lakh, it is mandatory to quote the PAN of your landlord. If you're not quoting the PAN of your landlord, your HR may reject your entire HRA claim. If it is LTA, you will have to submit the travel bills. Domestic travel is permitted, and if you're boarding a flight, you may also be required to submit your boarding passes. So if you plan to claim LTA, make sure you keep the boarding pass in handy as well. If you're claiming any of the deductions under Section 80C, then whatever are the investment receipts or the expense receipts. Similarly, for 80D deduction, we will require the medical expenditure, the medical premium receipt, or if you want to claim medical expenditure, all the medicine expenditure bills. If it is a housing loan, then the final interest certificate issued by the bank. If you want to claim petrol and driver allowance, whatever are your fuel bills. For petrol and driver allowances, please connect with your finance and payroll to understand what are your organization's policy around going ahead and making these claims. If there are any other expenses you want to claim, such as broadband, mobile, etc., whatever are the actual bills, they will have to be uploaded on your HR portal. Now let us come to the second segment, updated ITR. Now this can be very useful to people who were not able to file the ITR. So we all know the return filing deadline for salaried individuals is typically 31st July of every year. What happens if you miss the 31st July deadline? Can you still go ahead and file an ITR? Yes. If you miss the 31st July deadline, you can go ahead and file a belated ITR up to 31st December of the same year. So, for example, for the assessment year 24-25, that is the assessment year gone by, if you missed filing your return by 31st July 2024, you could have filed a belated return by 31st December 2024. But what if you're not able to file an ITR by 31st December 2024 as well? What do? You can go ahead and file an updated ITR or an ITRU. Now, ITRU helps those taxpayers who, for genuine reasons, are not able to file an ITR but need their ITR for important purposes. For example, sometimes banks do not process a loan if you're not able to submit ITR or your income statement. Similarly, if you're planning to travel abroad or go abroad for higher education or move abroad for the purposes of employment, you may be required to submit your income statements. If those income statements are not available, your visa may be rejected. So in such cases, an ITRU is a very effective tool. You can go ahead and file an ITRU for two previous financial years, up to two previous financial years. There are certain eligibility and ineligibility conditions. Let us understand the eligibility criteria to file an ITRU. You can file an ITRU if you have not filed a return previously, or if in the filed return an income was not reported correctly, or an incorrect tax rate was applied. For an income to be charged at the rate of 30%, you have taken a 20% tax rate, for example. Or if you have carried forward loss which are inflated or which are not in the correct number, or if there is any unabsorbed depreciation which you have carried forward in an inflated form. So to rectify all of these things, you can go ahead and file an ITRU. What are the cases in which you cannot file ITRU? You cannot file an ITRU if it is a loss return. That is to say, if you want to file a return declaring higher losses, you will not be eligible to file an ITRU. Similarly, if there will be a reduction in your tax liability or increase in your refund, you will not be eligible to file an ITRU. Or if your assessment has been completed or it is pending, in such cases as well, you will not be eligible to file an ITRU. The reason is simple. The income tax department is giving you a window of opportunity wherein you can go ahead and file an ITR for your personal purposes. However, since you have missed out the original deadline, there has to be some sort of a penalty. So these are the cases wherein you cannot file an ITRU. Separately, filing an ITRU entails additional tax liability. So if you're filing an ITRU within 12 months from the end of the relevant assessment year, then you will have to pay additional tax to the extent of 25% of the outstanding tax liability. If you're filing an ITRU after the expiry of 12 months, but before 24 months, then additional tax liability of 50% of the outstanding tax shall be applicable. The time limit for filing an ITRU for the assessment year 2022-23, which is financial year 2021 and 22, is 31st March 2025, and for the assessment year 23-24, it is 31st March 2026. For the assessment year which just went by, which is assessment year 24-25, filing of ITRU has been opened up. You can go ahead and file an ITRU up to 31st March 2027. However, please be aware of the interest consequences and the additional tax liability payable. Now let us take a quick look at the highlights of the budget 2024. The biggest highlight of the budget 2024 was that there was no changes under the old tax regime. All the changes with respect to personal taxation were made only under the new tax regime, and the new tax regime became the default tax regime. So for some reason, if you're not able to make a choice of the regime that you want to opt for at your employment, by default, the new tax regime becomes applicable to you. However, at the time of filing the return, you are free to switch between the regimes if you're a salaried taxpayer. Secondly, the standard deduction under the new tax regime has gone up from 50,000 to 75,000. So as a result, your income up to salaried income up to 8.25 lakhs may not be taxable. Deduction with respect to family pension has increased from 15,000 to 25,000. Deduction with respect to employer's contribution to pension under the new regime has gone up from 10 to 14% of your basic salary. In budget 2024, it was also clarified that any income that you get from renting out your residential house property will be taxed as income from house property and not income from PGBP, that is profit or gains from business or profession. The biggest chunk of reforms under budget 2024 was rationalization of capital gains, as a result of which any long-term capital gains will now attract tax at the rate of 12.5% vis-a-vis the earlier rate of 10%. Correspondingly, the total exemption limit for long-term capital gain has also been increased from 1 to 1.25 lakhs. Short-term capital gains now will be taxed at the rate of 20% vis-a-vis the earlier rate of 15%. Lastly, the most important reform, any indexation benefit on sale of residential house property or sale of land or building has been removed. So now you will not be able to claim any indexation benefit on sale of land and building. Directly, whatever are the profits will be taxed at the rate of 12.5%. And another important change with respect to capital gains was now there are no multiple holding periods. There are only two holding periods, 12 months and 24 months. All these changes with respect to capital gains kick in from 23rd July 2024 onwards. Now let us take a look at the tax slabs under both the regimes. So under the old tax regime, the tax slabs are as follows. Income up to 2.5 lakhs is not taxable. Income between 2.5 to 5 lakh is taxable at the rate of 5%. Income between 5 to 10 lakh at the rate of 20%. And income above 10 lakhs is taxed at the rate of 30%. Surcharge rates are applicable if a person's or an individual's income exceed rupees 50 lakhs. The rates of surcharge are 10, 15, 25, and 37%, depending upon the income above 50 lakhs. Lastly, there will be a cess applicable at the rate of 4%. Now, if you're an individual who falls under the old tax regime, the basic exemption limit differs depending upon the age of the person. For a person below the age of 60 years, the basic exemption limit is 2.5 lakh. For a person who is above the age of 60 years but below the age of 80 years, the basic exemption limit is rupees 3 lakhs. And for a person who is above the age of 80 years, the basic exemption limit is rupees 5 lakhs. Under the new tax regime, the income slabs are as follows. Up to 3 lakhs, there will not be any taxes. Income between 3 to 7 lakhs will be taxed at the rate of 5%, 7 to 10 lakhs at the rate of 10%, 10 to 12 lakhs at the rate of 15%, 12 to 15 lakh at the rate of 20%, and income above 15 lakhs will be charged at the rate of 30%. The applicable rates of surcharge under the new regime is 10, 15, and 25% for income above rupees 50 lakh, followed by cess at the rate of 4%. Under the new tax regime, the basic exemption limit is fixed at rupees 3 lakhs, irrespective of the age of the person. So, with this, we come to an end of today's session. Thank you so much for being such a wonderful audience. I will now open the door for questions. So, if you have any questions, put them in the chat box. I also see that we already have a lot of questions in the chat box. So,
Yes.
let me go ahead and answer the question. And
Okay.
after that, if you have any questions, you can also raise your hands and ask.
Megha, can you also see the Q&A bar?
Yes, sure, Pinkasha.
So what we can do is we begin with the chat option and then we move to the Q&A.
Yes.
Okay.
So, we have first question by Mr. Pavan. So the question is, I purchased a residential plot, do not intend to build a house on 4th April 2024, which involves stamp duty of 1.22 lakhs. Can I avail ATC? Okay, I would request the participants if you could please put your questions in the Q&A box because I'm reading the chat, and as soon as somebody puts a question, I'm not able to read the entire question. Can
Okay.
I avail?
If it helps you, Megha, what I can do is you can stop your screen share. Then you'll be able to move along the chat if that.
Yeah, I can do that. Thank you. And let me try it.
Yeah.
Yeah, I think, yeah, this is perfect. Okay, just give me a second, Pinkasha. I'm just opening the chat. No, Pinkasha, I don't think it is helping because every time there's a new question put, the entire chat window is changing. If the audience members could please put the questions in the Q&A, that would really help.
Okay. What I can do is, shall I read out the questions for you? That help you?
Yeah, that also works.
Okay. Do you want me to repeat Pavan's question?
So Pawan's question is clear. So Pawan, yes, you can go ahead and claim a deduction towards the stamp duty paid. Whatever is the stamp duty paid, it will be covered as part of your sale deed. So you can go ahead and submit the sale deed as a proof of payment and claim the necessary deduction.
So next question is from Awares Afzal. If we start investing in tax saving plan from today, can we avail a tax benefit this year or we benefit in last year 2024?
Okay, so always any investment you make from 1st April 2024 to 31st March 2025 will help you get tax deductions for the upcoming assessment year. So the financial year in India starts from April and ends in March. Any investment you make, even on 31st March, will be considered for the same financial year. I hope that's clear.
Great. What is the maximum LTA amount that can be claimed?
LTA. So as I mentioned again, the amount of LTA is dependent upon the actual quantum of expenditure subject to your organization's policy. Let us say your organization lets you claim a maximum of rupees 1 lakh towards LTA. If your actual expenditure is 70,000, you will be eligible to claim 70,000. On the other hand, if your actual expenditure, let's say, is rupees 1.2 lakh, in such cases, your LTA exemption will be restricted to rupees 1 lakh.
Okay. Can we claim HRA for the rent paid to parents if there is a proper rent agreement and we pay the rent?
Yes, you can go ahead and claim HRA for any rent that you have paid to your parent. However, two things to be noted here: your parents must be the owner of that home, and there must be a rent agreement between your parents and you. If you satisfy these conditions, and if the rent paid is more than 1 lakh, then you will have to submit the PAN of your parent as well. So, if you satisfy these conditions, you will be eligible to go ahead and claim HRA.
Okay. If a person engages with any organization, in that case, LTA is applicable for organizational travel costs or they can claim any travel amount.
LTA typically is for your personal travel. If you're making any organizational travel, that usually works on a reimbursement basis. The company goes ahead and reimburses these travel expenses or travel allowance. So these are two different things. LTA is purely for your personal travel.
Is stamp duty equivalent to registry value?
So now this is something only a real estate expert can answer. But however, as far as my knowledge goes, not necessarily. Different states have different stamp duty charges. So there can be a varying amount between your stamp duty charges and the registration charges.
Okay. Electric vehicle purchase deduction details can be okay. Can you explain me the deduction details for tax?
Yes, so electric vehicle first and foremost, they come with a sunset clause similar to Section 80EB. So if you have taken any electric vehicle loan, you will be eligible to go ahead and claim a deduction of up to rupees 1.5 lakh per annum. However, the loan must have been sanctioned between a definitive period, which is 1st April 2019 to 31st March 2023. Only if these two conditions are satisfied, you will be able to claim an EV loan interest payout.
All right. What is the procedure for opting for VPF and what is the time window?
All right. So VPF essentially is an extension of EPF. I hope that's clear. You simply have to go ahead and let your employer know that you want to contribute more than the EPF limit. The moment you let them know, they will go ahead and make provisions wherein you can make an additional declaration of what is the amount you want to contribute to. As regards the timeline and time limits, you will have to connect with your HR payroll because they will be able to let you know how long will it take to process your request.
Okay. Is ELSS withdrawal taxable after 3 years?
ELSS withdrawal will not be taxable after 3 years. It depends on the nature of gains you make. So, if you have made a capital gain, then yes, such capital gain will be taxable. And if you withdraw ELSS between the lock-in period, then not just the capital gains, you will have not just the capital gains impact, but also whatever is the amount of deduction you claimed earlier, such deduction will be added back to your income. For example, you invested in ELSS rupees 1.5 lakhs in Jan 2025. Now, the 3-year lock-in periods ends in Jan 2028. Before that, let us say in Jan 2026, you went ahead and sold your ELSS. You purchased them for 1.5 lakhs, you sold them for 3 lakhs. So now you will have a capital gains impact on the 1.5 lakh gain you have made. In addition to that, whatever was the amount of investment, which is rupees 1.5 lakh, this deduction will also be added back to your income. So you will end up paying taxes on this 1.5 lakh also as your income element because you broke the lock-in period condition. I hope that's clear.
Got it. If I'm paying tuition fees for my siblings, can I avail the deduction?
No, sadly, tuition fee is available only for your children, maximum of 2 children.
Okay. In section 80 CCC, is NPS covered?
Yes, as I mentioned earlier, Section 80 CCC has a separate provision altogether. So under Section 80 CCC, if you're contributing to any annuity plan of LIC, such investment will be eligible for deduction.
I pay for my great grandmother's care, not an immediate dependent. Is it tax deductible?
So when you say you're paying for her care, is she already covered under any existing insurance? So that is a question I would first want to answer. If she is not covered, then yes, you may be eligible to go ahead and claim. But if she is covered, then you will not be eligible to claim any deduction.
Okay. Under 12B AA, are mutual funds and SIPs included as well?
As I mentioned, any investment you make to an ELSS mutual fund, that will be eligible for deduction under Section 80C. Now, 12BA is a form, or 12BB is a form in which you make the declaration. So these are two separate things.
Understood. Can you help me with an example to understand what exact investment proof needs to be submitted for ATC?
For example, let us say you are investing, you have a child and you're claiming tuition fee for the child. In that case, the school issues an investment tuition fee receipt that constitutes as submission proof. If you have taken a life insurance policy, the premiums that you pay, the moment you pay a premium, a receipt is generated. That receipts constitutes as investment proof. If you have invested in FDs up to rupees 5 lakh, then the moment you make an investment, a receipt is generated. So you can go ahead and submit those receipts. Such receipts contribute as investment proof.
All right. I am having an inquiry for LTA. I had traveled in the last financial year and returned in this current financial year. Mumbai to Thiruvananthapuram, 26th March 23, and returned from Thiruvananthapuram to Mumbai, 2nd April 24. Can I claim both?
So again, LTA includes round trip travel expenditure. So as long as it is within the block, so the block is 2022 to 2025. So between this block, you can go ahead and claim LTA. So it does not matter if it moved from one financial year to another financial year, the round trip expenses will still be eligible for deduction. Now, it will be eligible for deduction in the previous year. So the start, when did your journey start? So your journey started in March 23. So the relevant financial year will be financial year 22-23. However, if you have missed that window, then you can connect with your organization or your HR and explain it to them, and they will help you claim it for the relevant financial year.
Okay. Term life insurance, will it be covered under? And if yes, then under which section?
Under Section 80C.
Got it. Does ITR chargeable or a paid service?
If you want to go ahead and file an ITRU, you can go ahead and file an ITRU by yourself on the income tax portal. However, if you are availing the service of any other organization or availing the service of Cleartax, then yes, there will be an additional payment that you have to do to avail the service.
Understood. What is the tuition fee limit per child?
As I said, the tuition fee limit is capped at the maximum of 80C limit. So up to 1.5 lakh can be claimed. However, please remember, only tuition fee is allowed. Any other fee by whatever name called will not be allowed. And this tuition fee must be paid only to a school, college, or university. If you're paying this tuition fee to any coaching center or any other preparation center, for example, IIT preps, etc., then that tuition fee will not be eligible for deduction.
Okay. There is an ongoing TDS deduction on interest of my mother's FD. Does that come under 80TTA for me to file expenses eligible for deduction?
All right. So if whatever is the interest your mother is getting from her FD, if it is getting tax deducted, then whatever is the tax that is being deducted, you can go ahead and claim it at the time of filing the ITR. Or if your mother has any tax liability, then such TDS will be adjusted against the tax liability, and the balance tax liability, if any, can be paid.
All right. Can we claim housing loan in the new tax regime?
Under the new tax regime, housing loan cannot be claimed for a self-occupied property. However, if it is a rental property, then you can go ahead and claim the housing loan interest paid.
Okay. Can you please explain me the medical expenditure section 80D once again?
No worries. So medical expenditure section is very clear. If the age of the person is above 60 years and they are not covered under any medical insurance, whether it is a medical insurance you have taken separately or if you have covered your parents under your top-up plan at your employment, in that case, it is not applicable. However, if the person is above 60 years and not covered under medical insurance, you can go ahead and claim up to rupees 50,000 per annum towards medical expenditure. Now, this medical expenditure includes any diagnostic bills, any OPD expenses, any month on month medicine bills, or any other bills that you have to take care of medical requirements of the person. I hope that's clear.
All right. Okay. Do we need to pay tax for 8.5 LPA? I think it's the salary.
Okay, so this is again something only on the basis of your gross salary or net salary. We may not be able to tell if you have to pay taxes or not. There are various other things to be considered, your deductions, etc. So only if I have all those details, I will be able to confidently and rightly tell you whether you have to pay taxes or not.
Okay, this was a question from Sayed. Sayed, if you could elaborate on this in the Q&A, please do that. For LTA exemption, I have hired a vehicle to travel. Can I submit car invoice, road travel invoice?
So again, this is something, if the place is not connected by a flight or a train, then yes, I think you can go ahead and claim the car expenses. However, I would strongly advise you to once please connect with your HR and payroll to understand what are your organization's policy also. Because with respect to LTA, again, a lot of people may not know it, but LTA can be claimed only at your organization by submitting relevant proof. You are not allowed to claim LPA at the time of filing the return of income. And as a result of this, organizations can also have their own terms and conditions. So please connect with your organization, understand your organization's policy, and you can go ahead and claim this LPA.
Hey, sorry, Megha. What is the maximum limit for NPS in the new tax regime?
Under the new tax regime, your individual contribution to NPS is not allowed as a deduction. However, employer's contribution to NPS up to 14% of your basic salary is allowed as a deduction.
Sorry, under
No worries.
affordable housing loan, the exemption and how much can I claim and how many years can I claim it for under Section 80 EEA?
Under Section 80 EA, you can go ahead and claim the deduction until your loan payout is finished. However, the satisfaction of all the conditions is mandatory. If you do not satisfy even one condition, you will not be eligible for loan deduction under 80 EEA.
Back. For example, if my salary is 12 lakhs, which regime should I opt for? Can you suggest?
Again, we only your salary will not help us decide which regime may be more beneficial for you. We will also have to factor in what are the deductions, what are the investments. But as a thumb rule, these are the few pointers which may help you understand which regime is more beneficial. If you're a person who is saving intensive, you have a lot of tax saving investments, you have high expenditure, for example, higher HRA or LTA, etc. In that case, the old regime may be more beneficial. However, if you're an individual who is expenditure savvy or who is expenditure intensive, you have high expenditure leading to lesser tax savings or lesser investments. In that case, the new regime may be more beneficial. However, these are just guiding factors. For a detailed analysis, you will have to connect with a tax expert or a CA, or also I can go ahead and attach our tax calculation tool at the end. You can make use of that and understand which regime may be more beneficial to you.
Understood. How much can we claim in total, including everything? Maybe this was
So this is again, I have read out each of the section limits. So again, I will quickly redo the section limits if that helps. Under section 80C, you can go ahead and claim up to 1.5 lakhs. Under section 80 CCD 1B, which is additional contribution to pension, you can go ahead and claim additional 50,000 rupees. Under section 80D, if you're under 60 years of age, you can claim up to 25,000. If you're above 60 years of age, you can claim up to rupees 50,000 for medical insurance premium. Then section 80E, which is repayment of education loan, you can claim the actual amount of interest that you pay. Then donations, whatever is the actual amount of donation you make, you can go ahead and claim a deduction of the same. This deduction can either be 100% of the donation made or 50% of the donation made, depending upon the organization to whom you're making donations. Under section 80 TTA, you can claim up to rupees 10,000. Similarly, under section 80 EEA and EEB, which is additional deduction for housing loan and loan for EV, you can claim up to rupees 1.5 lakhs under each of the sections. Employer's contribution to pension, this is dependent on your basic salary. Under the new regime, it is up to 14% of your basic salary. Under the old regime, it is 10% of your basic salary. I hope that helps you.
Thank you so much. Okay. Yes. What is the tax exemption limit for the profit made on stocks?
If it is a long-term gain, then up to rupees 1.25 lakhs is exempt. However, if it is short-term gains, there are no exemption. The entire gain will be taxed at the rate of 20%. I also have a couple of questions I can see, Pinkasha. I'll just quickly run through them. There
Yes.
is one question from Snehal. Are treatments taken from IVF covered under medical expenditure? So practically, Snehal, again, medical expenditure is only for people who are above the age of 60 years. So practically, I don't think anybody who's above this age of 60 years may be opting for IVF treatments. So as a result of which, it may not be covered. But in the instance, in your case, if anybody above the age of 60 years is considering IVF treatments and they are not covered under any medical insurance, then yes, you will be able to claim the IVF expenditure. I hope that clarifies. So I think I have I'm done with the chat section. I can quickly take up a few questions from the Q&A.
Yeah.
I'll take up maybe 2 or 3 questions because we are also running out of time. Okay,
Maybe
one question is,
yeah. So maybe we can take up the rest of the questions on LinkedIn, and will you be able to answer it?
yeah, sure, that helps.
Cool. Yeah, please take it up.
Yeah, thank you. Thank you so much, everyone, for being such a wonderful audience.
I think we can take like 2, 3 questions. We just at 5:01. If you have another meeting,
Yeah,
then
sure. I can take up, as I said, I can take up 2 or 3 more questions.
yes, please.
Okay, so there is one question on donation. Donation is need to pay only recognized NGO, or we can claim any donation? No, if you're making donation to the eligible NGOs, only then you will be able to claim. So typically, if you have made any donation, then you will have to go ahead and submit the PAN of the NGO, the total amount of donation, and this donation has to be in an online mode only. Cash donations are allowed as a deduction only up to rupees 2,000. So these are the few conditions. Basis this, you will be able to claim ATG deduction. If you do not submit these details, you will not be eligible. Then there's another question. Do we need to submit tax proof in the new regime? No, there is no requirement to submit any tax proof under the new regime, as the deductions, most of the deductions are not available under the new regime. Mr. Dilip, for you to go ahead and claim any stamp duty, you must be the owner of the house. If you are not the owner of the house, you will not be eligible to claim it under Section 80C. There is a question on need help in tax planning. What will be the charges? So please connect with us at Cleartax. We have various plans for tax planning also, depending upon your need. So we will definitely be able to help you out. Next question is on rental income. So I will take this question because it's a unique question. If you are receiving, let's say, rupees 1 lakh as rent during the financial year, can we claim any deduction, or is the entire 1 lakh taxable? If you're getting any rental income, then the Income Tax Act allows you to claim two deductions. One is a standard deduction of 30%. So whatever is your rent amount, irrespective of that, 30% will be allowed as a standard deduction. So if you're getting rental income of 1 lakh, 30,000 will be deductible and the remaining 70,000 will be taxable. The second amount you can claim as a deduction is property tax paid on actual basis. So let us say you pay property tax of 10,000. So from 1 lakh, I will first deduct 10,000 property taxes. Remaining amount is 90,000. From this 90,000, there will be a flat deduction of 30,000 and the balance amount will be taxable as income from house property. There is another question, can we claim HRA and housing loan both? Yes, you can claim HRA and housing loan both if for part of the year you were in a rented premise, for part of the year you move to your own house. Or if for the purposes of your employment, you have moved into a rented premise in a different city, and the city of your original residence, you have taken a housing loan.
There's a question which says, I purchased a house in April. My mother, who is my dependent, lives in that house, but I live with my husband and I pay rent for that. Can I claim EMI for the house loan and the rent deduction?
You can definitely claim EMI for the housing loan. The rent deduction care seems to be slightly tricky. So here is where we will have to, make sure that all the conditions are satisfied. We need to understand whom are you paying this rent for, because if you yourself are the owner of the house, then you will not be able to pay rent on the same house. Instead, if your mother is paying the rent, then yes, she can go ahead and claim the deduction.
I paid stamp duty during the house purchase and my mother is the owner. So can I submit this as a...
I answered this question, I think.
Got it, got it.
Yeah, no worries.
I think Sayyad elaborated on his doubt. Like, can you see the one from Sayyad? I joined Tredence in September, and my
Yeah,
previous...
I will read that out.
Yeah.
I joined Tridents in September 24, and in my previous organization, I was not eligible for tax deductions. Since I am now eligible for tax deductions, do I need to pay tax for the entire financial year? No, so Sayyad, your taxes are typically computed on your income of the full year. And again, Sayyad, I would like to here highlight to you that if you have moved your employment between the year, make sure you go ahead and submit your previous employer's income to the current employer so that they can go ahead and compute your taxes in an accurate manner. Typically, what we have seen is whenever an individual moves organization, there is an additional tax leak at the time of filing the return of income. This tax leak is also accompanied by additional unwanted interest. So there are two things you can do, Syed. If you have any tax payable, you can either pay advance taxes before 15th March, or you can declare your income from the previous employer and make sure your current employer factors that income, so that if there is any TDS, such TDS can be deducted from your salary. I hope that clears.
He's saying that he did...
Syed, although you may have declared, if you have declared, then well and fine, you will be covered. However, just make sure that your finance team has actually considered the salary of your previous employer and then computed taxes. Just get this clarified. Yeah.
All right.
There is a question, can I claim LTA now if I traveled last year October? So when you say last year October, I am presuming you're referring to October 24. Yes, if you have traveled in October 24, you can definitely go ahead and claim LTA. However, if you have traveled in October 23, you will not be eligible to claim the LTA in the current year. Okay. So I think, Kasha, we've covered most of the questions.
Yes.
There is one question. Me and my roommate, both of us wants to claim HRA, and our rent per month is 10K. 20K per person, 10K. The question just missed.
Sorry. Yeah, it was that can we... and per
Yes,
month
you
rent...
both can go ahead and claim HRA, Vivek. However, your HRA will be restricted to 10K per person. Your flatmate can claim 10K and you can claim 10K. Again, your organization may have strict policies around it, because this is typically we've seen with organizations. You may also have to submit a declaration to your organization saying that you are claiming only 10,000 per month and your roommate or your flatmate is claiming another 10,000. All right. So with this, I think most of the questions are answered. We can call it a day.
Yeah, thank you for staying back, Megha.
Yeah.
What we'll do is we'll take up the rest of the questions over a LinkedIn chat. Please follow Cleartax and Pazcare so you can also see the post. And the recording of this session will be up on our YouTube channel by Monday. please give us time till Monday while we put up the recording, and keep sending us the questions. And we'll do a LinkedIn chat, and Mega request you to please answer it whenever you get
Sure.
it. Thank you so
Sure.
much.
Thank you so much, Pinkasha. Thank you, everybody.
All right. Thanks everyone who joined.